Welcome to Mind Your Money. I'm Alec Canal, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, This Week in Your Wallet, we talk about the consumer looking for low-cost alternatives as Americans get choosier about where they spend their dollars. And with the Federal Reserve expected to cut interest rates, the big question is, will mortgage rates follow? We'll discuss. Plus, Nepo babies are cashing in, and it's not just Hollywood or Wall Street kids. We'll break down what the research reveals. America's biggest retailer, Walmart, is once again driving home the message that customers are seeking value wherever they can. In the latest quarter, the company said it gained share across income cohorts, leaning into its lower price model heading into back to school and the holiday shopping season. Lower prices and value is a key theme we've heard from companies, from appliances to cleaning products. Here's Yahoo Finance's Brooke DePalma with more.
U.S. consumers are navigating all kinds of headwinds, from uncertainty around tariffs to elevated interest rates, and so they're looking for the best deal wherever they can. We heard from quite a few companies this past quarter that consumers are seeking value with just about everything in their house, from the kitchen cabinet to the cleaning closet, all the way to even their clothes. And looking to upgrade your household? Well, chances are you sought out value for that too. So let's start inside the fridge. Well, Coca-Cola and PepsiCo signaled the need for value right out of the gate. Coca-Cola's CFO, John Murphy, told Yahoo Finance, quote, "There's a lower income segment that is under pressure." He went on to say that in order to maintain that customer base, it plans to offer even more affordable options. And the same for mac and cheese and Jell-O maker Kraft Heinz. It saw volume decline by 3.4 percentage points in the second quarter. It also has to offset inflation of about 5 to 7% this year, so it needs to raise prices about 1%. And the company's CFO said on the call that it's being mindful about the current consumer situation, but some pricing is required. And from the pantry to the laundry closet. If you bought something like laundry detergent lately, well, chances are that you went for the cheaper alternative. At least that's what we heard from P&G CEO John Moeller.
We are seeing modest trade down within our branded portfolio. So within the different Tide offerings, there are some that are more premium than others, and we are seeing some trade down there. We're also seeing some trade down to brands that you mentioned, like Gain. We are not seeing any trade down as of yet to private label.
And so perhaps we're seeing a switch from Tide Pods to regular Tide detergent, but it's not just smaller household goods. We're also seeing this when it comes to larger ticket items too. Whirlpool CEO Mark Bitzer said at its earnings call that weakness when it comes to consumer sentiment impacted both demand and led consumers to choose to mix into lower end products. Of course, Whirlpool sells those high ticket KitchenAid mixers too, like I've been hoping to get my hands on. And if you think you were thinking about a home renovation, well, chances are you're looking for value there too. Lowe's CEO told me over the phone that consumers are, quote, waiting for more confidence in the economy before they spend. And they're leaning into this larger concept of both value, and Lowe's also leaning into that loyalty reward membership. They said that both those things are really working for them. They exited July with same-store sales growth up 4.7%. And CEO Marvin Ellison said to Yahoo Finance, quote, "We want to make sure we know how to offer our customers a value to get them to shop us versus the competition. We did this in the second quarter, and we think when the weather trends improved, we saw positive responses to this methodology. And we're hoping we'll see the same response when it hits the back half of the year." And the chances are you're likely seeking value all the way to your clothes closet too. Have you shopped at a discount retailer lately? Well, TJ Maxx, the off-price retailer, had a stellar quarter too. Same-store sales grew 4%. And CFO John Klinger said customer transactions increase at every division. We see this as an excellent indicator of the strength of our value proposition across our retail banners. Bottom line here, guys, value is the name of the game as we make our way into the back half of the year.
Markets are pricing in a high probability that the Federal Reserve cuts its benchmark interest rate at its upcoming September meeting. But hopeful homebuyers waiting for lower borrowing costs shouldn't expect a big change in mortgage rates. Joining me now to discuss is senior housing reporter Claire Boston. So Claire, let's start with the latest data. What did we see with mortgage rates this week?
Yeah, Allie, so mortgage rates did absolutely nothing this week. We are holding steady at 6.58%. The good news if you are in the market to buy a home is that this is the lowest mortgage rate we have seen in about 10 months. So 2025 low. That being said, 6.58%, it's not crazy cheap. It's definitely not 3%. And so I think a lot of home buyers now are still kind of on the sidelines, maybe waiting for lower rates. But, it's really unclear that we may see that at any point later this year.
And to that point, Home Depot did say that lower mortgage rates compared to the start of the year, that's at least propping up a little bit of that home buying activity. But when we try and connect the dots here between what the Fed does with its benchmark interest rate and how that bleeds through into mortgage rates, what's that connection and what did we see the last time the Fed cut?
Yeah, so I am hearing a lot of hype from people who say, I want to wait until September, the Fed's going to cut, mortgage rates will fall then, right? And, actually it doesn't quite work that way. Generally speaking, mortgage rates react more to kind of just a broad spectrum of market factors as opposed to just Fed rates. And actually last year the Fed cut in September and mortgage rates actually rose. The Fed cut 75 basis points over a couple of meetings and mortgage rates almost were at 7% by the end of the year, up from 6%. So, really no guarantee that we will get any lower from here. And one thing I think is interesting is, we were saying mortgage rates, they react to these market factors. We have a bunch of economic data coming out in the coming weeks, and that is the kind of stuff that, really moves mortgage rates and creates market volatility. So, I have heard from some economists, maybe right now is as good as it gets, but, that being said, it's very, very hard to be in the mortgage rate prediction game.
Yeah, and that's a common misconception. Often you have to look at what the 10-year yield is doing for how that trickles through into mortgage rates. But you have been talking to mortgage professionals on the ground. What are they hearing from their clients?
Yeah, so a lot of clients are saying, hey, I want to wait. And they say, they explain the stuff we're just talking about. The big thing that they often say is that timing the market is really, really hard. And so it's probably a good idea just to try not to do that. And, the most important thing is really when you are ready, if you feel like you can afford your monthly payment, that is kind of the good time to pull the trigger rather than try to guess if mortgage rates are going to move a little bit and, risk being disappointed and potentially lose out on a cheaper rate or something like that.
All right, key lesson for home buyers. Claire Boston, thank you so much. And you can scan the QR code below for more mortgage content on Yahoo Finance. Well, working for mom or dad's employer can really pay off. New data shows young workers with a parental connection earn 24% more in their first job compared to peers without that advantage. And the surprising part, nepotism isn't just a Hollywood or Wall Street story. It shows up across a range of industries. So here to explain is Yahoo Finance's Emma Ackerman. So Emma, how does having parental connections affect your income?
Yeah, so really interesting research from Matthew Steiger at Opportunity Insights at Harvard University shows that kids that are working for the same employer as their parent can expect to make about $6,700 more in their first year. That premium does slide to about $5,600 by the third year, but still more than their peers who don't have that same advantage. And one thing that's really interesting that Steiger found is this isn't really explained by, an Ivy Leaguer getting hooked up with a job at their dad's Wall Street firm. It's more mom or dad helping their kids get access to high-paying blue-collar work in manufacturing or construction.
And who tends to benefit most here? Is this just something we see among wealthier families or maybe certain positions for mom and dad?
So interestingly, it is still wealthier kids that benefit. If you come from a higher income family, you are more likely to work for your mom or dad's firm, and you're more likely to make more money when you do. This could be explained by a couple of things. One is your parent may be higher up in the company. The company isn't theirs, but maybe they're a manager, where in construction or manufacturing, if you're a manager, you can make well above $100,000. Another factor that could also help explain this is these kids, the ones who are benefiting may be the ones who don't have a college degree and would have worked in a lower paying entry level position if not for their parents' help, like retail or fast food. One thing I also find really interesting though is that it's really common to work for your parents' employer as a young person. About a third of young people do so by the time that they're 30, and 5% of people do so for their very first job.
Oh, super interesting. And the research also points to a lot of high-paying manufacturing roles that you were just talking about. But we keep hearing about manufacturing job losses. So how many of those jobs are still available on the market?
There's a lot that are still available, just not as many as there used to be. So more than 400,000 manufacturing positions are open as of last month, and some of these jobs are well-paying, offer good benefits, and a long-term career. However, we have seen the country shed millions of manufacturing jobs since the sector peaked in about 1979.
So based on the data, what do you think the big takeaway here is when it comes to nepotism in the job market?
Right. I mean, so we know that intergenerational mobility is really influenced by things like zip code and where you grew up. But I think what's interesting about this is it also shows that who you know is really important too. Mm-hmm. Having that parental connection can make a huge difference, especially in your first few years in the job.
Fascinating stuff. Who you know, key to all these jobs. Emma Ackerman, thank you so much. Appreciate it. Coming up, President Trump has signed an executive order laying the groundwork for alternative assets like crypto and real estate in your 401k. We'll break down the order and discuss the pros and cons for your retirement account after the break. President Trump's new executive order is aimed at giving retirement savers more choices. It would open the door for 401k investors to go beyond just stocks and bonds and put money into things like Bitcoin, real estate, or even private equity. Now, what that actually looks like is still unclear. There is no immediate change to how you invest. The order directs the SEC and the Labor Department to draft guidelines for plan administrators who will ultimately decide whether to include these options, and that could take months or even longer. But once that's done, employers could offer more options of mutual funds and investments to workers. Some big asset managers are already supportive. BlackRock CEO Larry Fink recently argued in his annual investor letter that private assets like real estate and infrastructure can boost returns and provide a buffer when markets get choppy. But not everyone is convinced. Some advisors warn that these investments come with more risk and less transparency. As legendary fund manager Peter Lynch put it, own what you know. And if you don't know it, stick with the basics. Well, President Trump has opened the door for crypto and private assets to be included in your 401k, but is that really a good idea? Yahoo Finance senior columnist Carrie Hannon is here to weigh in. So Carrie, let's start big picture here. What should retirement savers be thinking about when it comes to adding some of these alternative assets like crypto or private equity into their 401k?
Yeah, Ellie, I mean, it's a bit exciting to have something new to look at that might give you, kind of juice up your returns, which is a possibility with there. I think Larry Fink mentioned over a 40-year period, they could see a 15% jump in your returns. And that's kind of appealing, but that's the point, 40 years, okay? This is the kind of investment that the experts I spoke to have said that it really is for somebody that has a long-term horizon because of this. Number one, they tend to be very illiquid. You can't just cash out of these kinds of investments. They come with high fees. There are layers of fees in them. And there's very little transparency. It's very hard to open up the cover and see what exactly is invested in there. So for the average investor, it's a little bit daunting because you don't really know what you're investing in. So this is going to be a big challenge for someone, a 401k plan administrator, in order to meet a very big criteria, which is called fiduciary responsibility. This is something they have to do before they put these into your retirement plan. And that means that they are saying that this is in your best interest and it's above their own interest. So it's something that you need to be aware of, and they're going to have to really jump that hurdle in order to prove that. In fact, these are very good for people because technically they've been for very high worth people, and they hold them for long periods of time. And so they're aware of the risk involved. Most people, and I'll wrap it up here, Allie, if most people are in target date funds, right? They don't even know, those are plain vanilla investments. Most retirement investors are in those funds. They have no idea what is in their target date fund. So there you have it.
Yeah, a daunting task indeed. Now, Carrie, back in April, the CEO of BlackRock floated a new approach, 50-30-20 portfolio, 50% stocks, 30% bonds, and 20% in private assets. So that's a big shift from that classic 60-40 split we've heard about for decades. What do savers need to know about that?
Well, I think it's an interesting idea. There's absolutely a lot of positive thinking behind that, because things are changing quickly. The markets are changing. These are new ways to diversify what we have invested in, to sort of, when the market gets shaky and jumpy, you have a little more spread out your risk to a certain degree. But yet I say these are a bit more risky, but they may have more upside over time. So I think that it's something that we may see more of. That 60-40 portfolio has held pretty strong for a long time. But for those who want to take a little more risk, have a little longer time horizon, it could be an interesting concept.
And given everything here, Carrie, ultimately, what are experts saying about these plans to incorporate alternatives into retirement accounts? Are they welcoming that diversification, or maybe raising some red flags about the risks?
Yeah, Allie, they are raising red flags. I'm telling you, that's what I heard a lot of. But I will say this, for the one caveat is, I heard again and again, if somebody has a long-term horizon, they don't need the money in the next 10 years or something, if they in fact will take the time to get educated about what that is specifically that they are investing in, you should invest in what you know. That is the smartest thing to do. And it's maybe worth considering, but to start with no more than 5 to 10% of your retirement portfolio, because you want to start with baby steps, but really do that challenge to yourself. Do you know what you're getting into? Are you okay with that risk?
All right, Carrie, well, stick around because it is time for Ask Yahoo Finance Anything. It's our weekly segment, and this week we're focusing on Medicare. Yahoo Finance senior columnist Carrie Hannon is back with us. So let's jump right in here with the first question. Can you explain the difference between Medicare and Medicare Advantage? I turned 65 at the end of the year, and I'm confused. So, Carrie, what is that difference here?
Yeah, there's a lot going on here, but I'm going to try to just come down to the basics. Medicare is traditional Medicare that's provided by the government, and you generally have access to any doctor you want to use, any healthcare provider. You pay a premium each month for that opportunity to do that, and there's usually a deductible, but you have this access to unlimited providers for the most part, and you generally do buy a separate policy for Medigap, it's called, to cover all the things that the traditional Medicare is not covering, and you often add a drug program. So there's a couple of moving pieces there. Lots of people say this is like the best thing going. So it's really been tried and true. Medicare Advantage, on the other hand, is health insurance that is provided by private companies like United Healthcare and Humana. These Medicare Advantage plans have taken off. Of all the universe of Medicare enrollees, most of them, the majority, are now in Medicare Advantage plans. The big attraction here is these cover things that traditional Medicare does not cover. And so that is dental work, vision, fitness classes, that kind of thing. And those are very alluring to people. They usually come with no or very low premiums. And that's also attractive. Here's the drawback. Often you have to have pre-authorization to go to a specialist or have a certain medical care for yourself. And you are restricted to the doctors. You're limited to the doctors that are in that plan, that Medicare Advantage plan. So they may not be your personal doctor that you want to go to. So you want to make sure your doctors are in that plan if you go there. So really the drawbacks there, people get turned off by the pre-authorizations, which delay cares or maybe completely goes away, and not having their doctors. And I will add, Allie, that this has started to change. Medicare Advantage plans have now started to charge premiums, and there are lots of health insurers. They're starting to withdraw from some markets, and also hospitals and healthcare providers have sort of stopped taking Medicare Advantage participants because of these denials and their concern for the slow process. That's just starting, but we are seeing movement there.
Okay, perfect segue into our next question here, because one of our readers says, I am on a Medicare Advantage plan. What is pre-authorization for medical care actually mean? My doctor prescribed a new medication for me, and I was told they had to get it approved before I could get the prescription. You were just talking about some of those pre-authorization questions here, Carrie. So what should Americans know about that?
Yeah, bingo. That is a huge problem with many of these Medicare Advantage plans. Is your doctor has to get it signed off before they can, write that prescription for a certain drug for you, or whether you can have a certain procedure or go to a particular specialist. And as we age, we have more demand for these kinds of things, so it becomes a bigger problem. And over the years, this pre-authorization thing has become a big stumbling point, and it causes a lot of anxiety for people. And as I mentioned, healthcare providers are sort of throwing up flags here. Most recently this year, under the new administration they did have an informal meeting talking about ways that this approval process can be, for Medicare Advantage plans, can be sort of smoothed out a bit to make it a bit quicker for people to get these authorizations. But it can be a huge headache for folks.
All right, next question. I just read about a new program for traditional Medicare that will require pre-authorization. I am enrolled in traditional Medicare and live in Pittsburgh, PA. How will that impact me?
Well, yes, I don't think this is a laughing matter. This is a big deal. And if you live in Pittsburgh, Pennsylvania, guess what? You're okay for now. This is a test pilot program that the administration is checking out. It's just in 6 states right now. And I'm just going to look to make sure I get them right. It's New Jersey and Ohio and Arizona and Oklahoma, I believe. And there's probably 2 more in there. I can't read my own writing, but there are 6 states, and it's not Pennsylvania, so you're okay there. What this is, there's certain procedures they're doing, just testing to have pre-authorization for traditional Medicare beneficiaries, and they're having private companies do the scrutiny through using AI to analyze the request. There is concern about this. There have been congressmen and congresswomen have written a letter to the administration pushing back on it. It's not supposed to kick off till January 1st, so we'll see where this leads, but it could be just the first toe in to sort of making traditional Medicare a bit more cumbersome for folks.
And finally here, Carrie, I'm 60 and super worried about future long-term care costs. What might these add up to, and will Medicare or Medicare Advantage cover the cost of long-term care in nursing homes and assisted living facilities?
Okay, so let's start with the second part. No, they do not cover the cost of long-term care, either of those, for the most part. And that is really can be daunting, because that can be a huge expense for many people towards the end of life, for if you are in one of those facilities. What the number that I heard, if Fidelity is actually the one that runs this number every year of what somebody who retires right now at 65 could expect to spend out of pocket for medical expenses for the rest of their life. And this does not include that long-term care or assisted care thing. And it's $172,000 roughly is their estimate this year. I don't think most people have any clue that their health care benefits may cost out of pocket that much in the last couple of decades of their life. A lot of people think Medicare is going to cover it all, and guess what? It doesn't.
Well, Carrie, some great answers and context to these questions. Thanks so much.
Thanks, Allie.
Well, that's it for Mind Your Money. Scan the QR code below to sign up for the Mind Your Money newsletter, and stay tuned for Market Domination. That's coming up next.